Hello everyone. Firstly, we are on the onslaught of Unlock 4.0. So I hope up until now all of you are absolutely safe and secure in your respective homes or at your workplaces, as the case may be, in whichever location you are. As far as the bond markets are concerned, the month of August was a pretty lackluster stroke disappointing month. For starters, we had the Monetary Policy Committee decision on August 6th, which was at the start of the month, while the markets were expecting a status quo, and that was delivered. That was not the key reason for the bond markets being spooked. We actually saw subsequently the minutes of the MPC that were released. The tone or by some of the MPC members were not perceived very positive by the bond markets. So as a result, if you see the entire month of August, the movements in bond yields have been close to about 35 to 45 basis points, in some cases even 0.5% on the higher side. So the 10-year benchmark bond yields, the 2030 bond, which was around 5.8, 5.85, actually saw highs of 6.2 odd percent before closing in at about 6.1 odd for the month of August. So I think by and large, except for the very short maturity schemes like liquid or ultra short term, most of the categories in fixed income, at least for the month of August, closed in marginally in the red and slightly higher for the longer end. However, as they say, there is light at the end of the tunnel. On the last day of the month, the Reserve Bank of India chose to gratify the bond markets by doing a Shahenshah Act of announcing some measures to cool off the market sentiments. And why I said Shahenshah, because there is this famous dialogue in that which goes, "Rishte mein to hum tumhare baap lagte hai, naam hai RBI." So what did the RBI do? So they actually announced a special open market operations. And what is so special about it? They do a buy and a sell simultaneously. So the total amount is 40,000 crores, of which 10,000 crores has already been conducted in the month of August, and 30,000 crores will follow in September, wherein they buy long bonds, longer maturities, and sell short bonds. Why would they do this? Largely to flatten the yield curve. So the gap between the short end and the long end actually compresses. And second, it also acts as an anchor to the bond yields. So the upward slide in move of the bond yields tends to get arrested. Number two, very important, they also enhance the HTM or the held to maturity limits for banks from 19.5 to 22%. Now this we believe is very epic move, where about 2.5% additional would mean approximately 3 lakh crores of additional government bond demand, which is very important in a market which was reeling under supply pressure and no meaningful demand levers were visible. And of course, another measure, not maybe directly impacting bond markets, they've allowed the repricing of the rates for the banks who had borrowed under TLTRO on the lower side. So at the current levels, they get a benefit of approximately 1.15%. So 5.15 to 4%. So I think these were the bazooka moves according to us, which are very important to anchor bond market yields at the current levels, and more importantly give some sort of a signaling to the market that the yield curve is way too steep at the current juncture. The overnight funding rates or the reverse repo rate and the 10-year benchmark bond yield, the gap was almost little under 3%. So I think great move and a great end to the month. Of course, the impact will be felt in the following month.
Mutual fund
and the
investments
icing
are
on the
subject
cake,
to
if
market
this were to be
risks.
the cake,
Read all
the
scheme-related
Q1
documents carefully.
GDP data came in at minus 23.9%. This was the worst contraction on record. So I think a combination of the Reserve Bank of India moves and the GDP data. Of course, GDP is post facto. However, the number is slightly higher than market expectation, is likely to keep the bond markets buoyant in the coming month in terms of its trading volumes. So we believe that the view that we have been reiterating for some time, that bond markets will be volatile, but if you stick to your investment course, there is a potential for carry. Of course, there is a potential for capital gains that seems to be playing out according to us. So I think going forward also, with liquidity not being too much of a concern, with RBI committing to act even in future, all this bodes well for a bond market investor. So what should the investor do right now? A, continue to elongate duration. Liquid funds, overnight funds, we still believe will not give you that kind of carry or the yield chase if you are seeking that. Of course, it is high on safety because interest rate risk will be at the lowest end, but you need to stagger depending on your risk appetite, because we believe a combination of liquidity support and demand levers are very potent tools to pull down yields by another 15 to 25 basis points from the current levels. So make no mistake, volatility is or should be looked as your friend. We have seen volatile movements in the month of April, May, June, July were reasonably good payback period. Again, August has been a little bit of a dampener month, but it's absolutely fine. You need to look through these volatilities and focus on your broader investment goals, and more importantly, not deviate from your investment horizon. The incoming inflation numbers will give more clarity as to when is the likely next rate cut. In this particular case, however, markets will not be in a big hurry to expect rate cuts, given that other gratification levers announced by the RBI are very much in place. On that note, stay safe and stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.